Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I have a chance to talk to Gabriel Sacks, who is the lead manager of the Aberdeen Asia Focus Trust, which some of you with long memories may remember as the Aberdeen Asian Smaller Companies Trust a few years ago. Gabriel's been the lead manager the last couple of years. This trust long associated with Hugh Young, who was the head of the Asian coverage for Aberdeen and its many funds. And such a good time to talk about it, I think, because there's obviously been a huge amount of things going on this year. We haven't talked much about Asia on the podcast, but the markets there have been performing well. And this particular trust, which has a market cap of around 540 million, has been performing very well as well, up around 35% over the last year or so, and has a strong track record going back some 30 years. Average shareholder return about 12% per annum over that period, which is very impressive and puts it in the list of the best longer-term performing trusts in the list I put in the Investment Trusts Handbook. So, Gabriel, welcome to the podcast. Let's kick off and ask you, first of all, to give us a very quick snapshot of what the Aberdeen Asia Focus Investment Trust is all about. What are you trying to achieve, and what is your area of coverage, your mandate, if you like?
Thank you, Jonathan. It's great to be here. The objective of the trust hasn't changed over the 30 years that you mentioned there, which is really to give investors access to the best quality, smaller companies in Asia. So the philosophy is quite simple. We think we are extremely unique in the sense that a lot of the funds and trusts out there are more geared towards large cap in Asia. So this really gives you differentiated exposure to the region, deeper and broader access, and we can get into that. So, it's really about picking good businesses, solid management teams at reasonable valuations, and just riding the Asia growth story and avoiding the weaker businesses in the region.
What's impressive, you look at the numbers, is the fact that you have delivered very strong performance, as I've mentioned. And not only that, you've done better than the other couple of trusts that are in the equivalent subsector, but the volatility has been much lower than that of the other trusts, which is surprising in a way, given you're investing in small caps. You would normally expect that to be more volatile. And that obviously helps your risk-adjusted returns as well. So why is that volatility lower than your peer group, but also lower than perhaps some people might expect?
Well, you've raised a really good point there. I think one of the misconceptions of Asian small caps is that they are extremely volatile and higher risk. And perhaps at the individual company level, that might be true in the narrow sense that they are more niche companies. But, we're not talking about very small businesses in Asia. So these are companies around $3 to $5 billion market cap. So they're pretty well established companies. We like companies with strong balance sheets, good cash generation, and therefore they can be global leaders at what they do, not just a leader in their country. And because the region is so vast and we run quite a diversified portfolio, the correlation between those stocks is quite low. And within small caps, there's typically less foreign ownership as well, which means that the correlation to mainstream equities is lower. So when you put that all together, it means that if you run a diversified portfolio, you can actually bring the risk, if you measure risk by volatility, right, will bring that down. And so what you've seen with Asia Focus, if you compare it to a passive allocation to large cap, let's say, is that you've been able to deliver much higher returns and actually reduce the volatility. Now, that typically works particularly well if you combine the two. So my pitch on Asia Focus is typically, use it great as a standalone holding, but also great in combination with a large cap fund, I would say, because you get broad exposure to the region. Now, in terms of the peer group, I would say that one of the things that we have been quite conscious of doing, particularly in the last 5 years or so, is balance the portfolio by country and sector. And so I think some of our peers are more concentrated in particular areas. I can think of one of our competitors is very heavy in consumer stocks and in 3 countries, and the other is very heavy in 2 countries. So I think we're being a little bit more conscious about being diversified and balancing our exposures, essentially. And we do look at the benchmark these days as a comparator for the risks that we're taking. but we are extremely different to the benchmark. So our active share is 96% plus versus the small cap benchmark. And, my final comment here in terms of bringing that together with your first question about what you're trying to achieve is that when you look at a large cap Asia fund, 25, 30% now of that fund is in four or five stocks, right? TSMC is approaching 13% of the index. Samsung is another huge chunk, especially how it's been performing in Hynix and Tencent and Alibaba. So you have these mega caps, and you're getting the same issue you get in global and US markets where there's massive concentration around a few stocks. So I think the relevance of our trust is still great if you want that access to Asia, which is a huge part of the world.
So just to sort of round that off, the low volatility is not something you specifically target, but it just falls out of the process that you're following yourself and the philosophy of the trust, if you like.
Well, there's an element of low vol in our investment philosophy and style as well. So I would say that because of our quality tilt, these businesses can be more defensive and less volatile. I think one of the things actually that we have been conscious over the last 3 years or so is that maybe we were too defensive and too low vol. And actually, one of the things that we've tried to do is maybe be a bit more bold in taking risk and buying higher growth companies in structural areas that we see of growth. And that's inched the beta of the portfolio up a little bit. What that's meant is that we've been able to capture more upside in markets in the last few years. So if you look at the last couple of years, markets have been quite strong in Asia, small cap space, and we've been able to outperform. So that's partly because we want to balance the portfolio as well in terms of that bias perhaps that was too skewed towards being defensive, essentially.
Well, we're on the kind of style factors, if you like. You are in small cap, but small cap can mean quite large cap these days in absolute numbers. But we've seen in developed markets that a kind of quality growth style has been relatively unsuccessful. So we think of people like Terry Smith, Nick Train, and people like that in developed markets with a quality growth style. But it doesn't seem to be applying in the Asian markets you're operating in. Is that a fair comment?
I think it really depends. I think if you look at the large cap space, I think that would be true where quality growth has suffered. So if you look at the last 3 years or so, I think value has done better. Perhaps not as extreme as in developed markets and the UK, for example. I think value has done really well in the last year or so. But in EM, that's been true, particularly in China, I think, where post COVID, a lot of the things that did well were high dividend stocks, SOEs, which I think the locals had more faith in an environment of tougher regulation. They see these companies as surviving. And with flows out from foreigners, those typically have come from the more quality growth businesses in areas like consumer stocks, which have been tough. I think with small cap, because China's much lower representation, it's been inching up recently, but about 13% or so in the index that we use, which is the MSCI Asia ex Japan small cap index. So you have more representation from countries like Taiwan and India. And India historically has been, I think, investors there, which has been led by domestic investors recently, is they follow a more quality growth style. That style works really well in India. I think local investors don't really go for value stocks. So I think in 2024, for example, we did really well in India because our stock selection was strong. And I think in Taiwan also quality growth has worked, driven by the AI thematic and capex investments that we're seeing, the structural growth in semiconductors. So I think those are some of the reasons. So it depends a little bit on which country you're talking about and which part of the market. But I think in general, your comments are true that quality growth has been a bit tough. So it's good that we've been able to outperform in that environment because we are a little bit more quality, I would say, and inching a little bit more towards growth, although I think we've been quite balanced in style as well. We try not to box ourselves into being value or growth. We want to really buy the best quality businesses at the fastest growth rates at the cheapest possible price. So maybe quality at a reasonable price is how we're really trying to approach this.
Well, lots of issues to unpack here, but let's move on to 2025. Should we say quite a turbulent year for many reasons, mainly to do with the policies of President Trump and his administration. We had the great tariff announcements back in April, with one or two countries in Asia in particular being hit with very high tariffs, at least temporarily. How did that all play out for you? How did you navigate that? And what has been the enduring impact of that on the universe that you invest in?
Yeah, look, it's a really big topic and a lot that we can talk about there. One of the things that we've been trying to do for a while is to avoid companies that are exposed, or we see that they are exposed to tariff risks. So trying to avoid, let's say, Chinese businesses that are pricing in growth in the US, for example. We don't really factor in any growth in the US for Chinese businesses, really. If it happens, it's great, but we really see that as a closed off market, largely speaking. There are some exceptions. The other thing is that prior to April, we reduced our Vietnam weight. Vietnam has been our largest overweight to the index. And, I've been very bullish Vietnam for quite some time, but I thought that, maybe we should just be a little bit more prudent, because Vietnam, if you look at their export exposure or a deficit that they have in trade, they're the largest behind Canada, Mexico, and China. So they were probably on the firing line for Donald Trump. And, that transpired. But the impact was temporary. And after we reduced Vietnam from about 7% to 5%, which was a big change, we started going back in there. So we didn't do any massive changes. We didn't want to have knee-jerk reactions at the company level. Our perspective on tariffs is, this might be more of a personal view, is that it's more damaging to US consumers and drives higher inflation in the US and possibly slows global growth, which isn't good for Asia, but it's more of an indirect impact. And therefore, there wasn't too much that we felt we needed to do at the portfolio level as a consequence of that. But, obviously, that's summarizing a lot of discussions that we've had around tariffs at both the country level, sector level, and company level. And we have a large team of analysts. We're 50 people across EM, about 40 in Asia. And we spend a lot of time analyzing this at the individual company level.
It's interesting. I mean, the shares, I think, sold off by something like up to 20% in the immediate aftermath of that. But of course, that was quite a common experience across very many markets. But you didn't do anything radical, as it were, in response to that, just what you've said. And since then, it's been kind of all one way, pretty much. The markets have been very strong, haven't they? So what's driving that? I mean, can we analyze that in terms of flows? Who's been buying the Asian markets? Has it been mainly people fleeing from the US, or has it been more an understanding of the actual dynamics of the Asian economies and the companies you're investing in?
So there's a few reasons. I think, broadly speaking, you've seen a bit of a return of China. China was being regarded as uninvestable a couple of years ago. And I think 2025 was the year that you've seen, despite the tariff rhetoric, China perform well again. And I think that's bringing people back to EM, as it were, more broadly. And because China is such a big part of the EM and Asia story, that tends to help from a sentiment point of view. You've seen a weak dollar, which has perhaps been quite surprising as well, but it's helped on the currency side. But I think when it comes to our part of the universe on the small cap, it's more driven by local investors. So markets like India continues to see very strong flows from domestic investors. China, you've seen a return as well of some domestic investors. Some of it is more top-down driven by the government. So you have this national team buying, and it's been a bit more thematic around areas like AI and robotics and biotech. And that's also been driven by the innovations coming out of China with DeepSeek. And I think the final piece has been the AI story, which many investors will think you need to play AI through NVIDIA and the US hyperscalers, but actually the Asia supply chain is really enabling AI, and there's a big part of that in our universe. So Taiwan has been a really, really strong story. I think that's not just driven by locals, but by foreign investors as well. And then towards the end of the year and into this year, Korea has really been driven by the memory semiconductor cycle, and also this corporate value up story, which is trying to mimic the Japanese experience. So lots of different reasons. But I do think markets have perhaps been a little bit complacent around the risks. So I've been surprised at how strong markets have been since April last year. But, I think that the tariffs and the geopolitical issues are also reducing trust in the US. And because of concentration in markets, I do think we're having more conversation with clients, investors that are looking to diversify again after a period when actually all you needed to own was US equities, right? I've said a lot there around it, but I think there's lots of reasons why Asia is doing a bit better. But frankly, there hasn't been huge flows to small cap, foreign flows at least. So it hasn't been a big driver yet. And, when that happens, you tend to see a bit of a squeeze and valuations run up quite quickly.
I'd like to come back to the AI point, but on that last point, You say it hasn't driven up valuations of small cap in particular. Can you quantify that at all? What would be a kind of average valuation metric for the universe you invest in? And where would we be today relative to that?
Yeah, so I'd have to triple check the numbers here. I think low teens, mid teens forward PE is an average. We're probably sitting above that at the moment. So, not to say that we haven't seen a re rating. So, certainly in India, there was a big re rating back in 2024, and 2025, India really lagged the broader index. Earnings are still reasonably strong, but expectations were quite high. So, I would say that there are parts of the market that have become more expensive, and those would be India, Taiwan. Taiwan has really been driven also by earnings. Expectations have continuously been revised up. But yes, there has been a re-rating there. So I'd say those are the more expensive parts of the market. Southeast Asia, which not many people talk about, is a very cheap part of the market, and that's about a quarter of our portfolio.
Just there, you mean Indonesia and Philippines and things like that?
Yeah, exactly. There's quite a few small markets there. So Vietnam is our biggest, but there's Indonesia, Philippines, Malaysia, Singapore, Thailand. We have one holding in Sri Lanka, which is more play on India. But, together those are small, but they add up. And all those markets are largely ignored by foreign investors because they're small. They're not big parts of global indices. So they're a rounding error. Also, they don't have the best narrative in terms of selling a good investment story at the moment because of the politics as well. So it's less clear cut when it comes to investing there. And Indonesia has been in the news a lot the last few weeks. So we can talk about that as well. But, all these countries have some bigger political challenges, I would say. But that doesn't prevent them from having great businesses that are still growing nicely and are delivering great yields. We can get high single-digit yields with some of these names, which are also growing high single-digit earnings.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. You mentioned AI before, and Asian countries being part of the enabling of the AI phenomenon. And obviously there's chip makers and, as you mentioned, memory chips and so on. What is your take on that? You're obviously feeling the breeze from the kind of extraordinary AI phenomenon in the US. Do you have a view on how that's going to play out and whether that's going to have a lasting impact, whether it continues at its current rate or whether it declines as many people fear it might? Do you have a view on how that might play out and how it will affect the kind of companies that you might be investing in?
Yeah, absolutely. So this is really the key question of the next year or two. There's no denying that AI is pretty transformational from an impact perspective on societies, economies, and just the sheer numbers that these US companies are throwing at it. So just this week, you saw, and I think this was yesterday, Meta, Google, and Amazon, they're increasing CapEx by 50 to 90% for this year. And given the size of these companies, that spending is phenomenal. And it has a direct impact on the supply chain, the hardware suppliers in Asia. So what we're seeing is very strong earnings from the Asia supply chain. Now, the big question is, how long does that keep going? And, our expectations getting ahead of themselves, valuations too high. So we've been taking profit. We've done well out of the AI supply chain. One could argue maybe taking profit a bit early, but we think it's prudent to be rotating out of some of these names or just taking profits and adding to areas of the market that are less in vogue. But having said that, we are concerned a bit about the potential for overbuilding in the US and how I don't think anyone really knows whether they'll be able to monetize this capex because AI is still in its early days. So, I think that the hyperscalers feel they need to because they're all in an arms race now and they're starting to compete with each other. And it's possible that they'll be able to monetize this because the progress that you're seeing, you have these developments with Claude agents, and that's causing a massive sell-off in software and IT services companies at the moment globally. But, that's still very positive for the hardware side if they actually manage to monetize that. But, I do think that the returns are likely to disappoint. So I do think that the music slows, doesn't end, but it will slow, and that will impact the Asia supply chain as well. So we need to be very sensitive and monitor developments there. And so what we've been doing in the portfolio is we've had some great performers. We've been rotating those into laggards within IT as well, areas of the market that haven't performed so well, and in other areas. So a good example of that is Taiwan was leading the charge, and that baton has passed a bit to the Koreans now because the memory cycle tends to lag a little bit. And so our largest holding at the moment is a company called Hansel Chemicals in Korea, it's a very diversified business, but one of the key businesses is it provides chemicals and wafer cleaning agents to Samsung and Hynix. And so it's a direct beneficiary of CapEx of these memory makers. And it's quite a cheap stock. It was offering good yield. And now that's been re-rating, we'll have to think about what to do with it. So, we're trying to find laggards in areas of the market where we see upside. But it's a big question. I think, again, we want to keep a balanced, diversified portfolio and not put all our eggs in one basket.
You mentioned earlier about DeepSeek and the Chinese involvement in the AI developments. The other kind of arms race that might be going on is, of course, at a kind of strategic government level, China against US. And they would both have a vested interest in not seeing their participants in this AI phenomenon lag behind. So that might keep demand being driven for longer, if you like, more intensively. What's your interpretation of how the Chinese are approaching this whole phenomenon, as I said?
So I actually raised a good point that I didn't mention, which is the whole AI ecosystem in China, which is an area that we've been doing a lot of work in, and we would like some exposure to in the portfolio as well, because again, it helps us balance the risks within the whole AI evolution, right? And we think the Chinese are making some big inroads, and the way they're approaching it is really to try to be more self-sufficient and localize the supply chain as much as possible. So if you see NVIDIA was firstly blocked from selling GPUs to China, or the high-end GPUs to China. Then Donald Trump allowed them to sell some sophisticated AI. And actually China said, we're actually going to give quotas and reduce the amount of these chips that we want coming in because we want to force the locals to develop their own technology. And they are certainly behind on the advanced chip side and lithography and whatnot. But, shouldn't underestimate the ability of the Chinese to find ways around it and innovate in different ways. And perhaps they don't need the most powerful chips if they can find different ways of packaging chips or combining things. So, I'm not a tech expert, but we do spend a lot of time looking at the supply chain there. So we don't have direct exposure at the moment to that theme, although we have some equipment manufacturers that are increasingly selling into parts of so Precision Tsugami, which is one of our largest holdings, they sell precision equipment essentially, and they're selling to liquid cooling players. And with AI, you need more liquid cooling in servers. And therefore, it's sort of a play on AI in China, if you see what I mean. But it's one that's backed by fundamental growth and earnings and not hype, because there's a lot of early stage companies in China that are trading at very high valuations on the potential that they'll be a leader in AI, and it's still difficult to find winners. So that was a very long answer. I think geopolitically, it is a big question. I think no doubt there is a need from the US perspective to contain advances in China in tech when there is mistrust on political objectives there. I think what's transpired is Donald Trump is probably less of a national security hawk and more of a transactional deal maker. So actually that's played into China's hands to an extent where they're buying time and continue just to become more self-sufficient. So what you've seen in China is a massive focus on industry, advanced manufacturing at the expense of the property sector infrastructure, which was the old model. And you see in the export numbers from China, massive trade surplus because they're a leader in many different areas of advanced manufacturing, particularly around also renewables, robotics, that kind of thing. And I'm laboring on here, but on the energy generation side, China is well ahead of the US, and that could be a bottleneck for the AI story as well.
So just in terms of the wider geopolitical issues, I mean, there are a lot of potential flashpoints in Asia. Obviously, Taiwan and South Korea, and a lot of political developments, as you mentioned earlier, referring to Indonesia, I think in particular there. You can't control that, of course. There is the kind of philosophy, well, I can't control it, therefore we just have to kind of largely ignore it. That's one question. So how do you deal with it? And the second question is, do you actually have some fears about how that might develop? I mean, there's a lot of economic cooperation around the region. Is that really going to be disrupted by some kind of military action or developments that people have talked about, like obviously Taiwan? How do you think about all that, and how do you personally assess how that might play out over the next few years? Big question, I agree.
Yeah, look, I think we need to be humble in a topic like this and say we don't know, and there are tail risks. That's the reality, and we need to be extremely sensitive to what's going on and speak to as many people as we can who are experts in this field. I think the Taiwan issue has been an issue forever for China. Our perspective is that China has been quite pragmatic in the way that it runs the country and requires being linked to the global economy. They need access to global markets. And whilst Taiwan is not something they'll let go of, it's a massive risk to do something militarily, particularly when the military in China hasn't really been tested. And there's massive chaos in the Taiwan military at the moment. You saw Xi Jinping fire to people in the highest body in the military, and actually that's been purged for the last 5 years, essentially. So there's disarray in the high-ranking military bodies in China. You'd also be a country which historically has had a one-child policy, sending your kids to fight other ethnically Chinese people. It's happened to an extent, you could argue, in Russia, perhaps, which is, very close peoples, but it's a big ask. So my view is they probably play the long game. China has the benefit of playing the long game and then incorporate Taiwan like they did Hong Kong. I think that's what would be the pragmatic solution in the Chinese eyes. But, you never know what Xi Jinping is thinking. He's talked about trying to do it in his term or his lifetime. So you can't dismiss that risk. And it depends a little bit on how the US and the Taiwanese themselves approach the situation. So we need to be careful and sensitive, but it is a risk for everyone. I think if that happens, as I said, the AI supply chain is very reliant on the semiconductor cluster in Taiwan, which is almost impossible to replicate overnight. So it is a big risk for Apple, Meta, all these companies as well. So it'll be a bloodbath in markets. And we just have to make sure that we can also get out quickly if something like that happens and focus elsewhere in places like India, Southeast Asia, which are big parts of our portfolio, right? So that's maybe not a great answer to the question, but we try and be as well informed as we can and keep a balance in the portfolio. Otherwise, there's regulatory risks everywhere. In the media in the West, there's always a critique of a Chinese model, but you need to understand that it also has helped bring a lot of people out of poverty. There are benefits to the way that they do things. I'm not agreeing with all the human rights issues, of course, but it's just a different model, and each country has their model. And one of the things that they have been doing in Asia is reforming and transforming their economies and investing in areas that will move the countries forward. So I think that is positive, and there's a lot of good things happening as well.
There are some people who think that the Chinese economy is in trouble, and they've got a lot of debt, and they're having to run harder, even for a repressive regime, to maintain popular support. Do you see any signs of that? From what you've been saying, the answer to that would appear to be no. They are transitioning the economy from one model to another, as you said. But is that a concern that we should worry about? It's a concern that faces a lot of developed countries as well, of course, the high indebtedness.
So there's a few elements that I think, as you say, debt is a problem globally, particularly in the US, in my view. But yes, in China, there is a lot of debt. It is concentrated in particular areas, particularly local governments. So at the central government level, debt is actually low, much lower than the West. And so one of the things that the government has been doing, but has been a bit slow, is to transfer some of the local government debt to the central government to ease the burden on local governments and allow the economy to function better. There is debt in the property sector, although recently the government has removed their 3 red lines policy, which was basically limiting lending to these property developers, which was really an engineered policy to reduce excess in the property market. But at the household level, aside from the central government, household balance sheets are great. There's a big savings culture in Asia and China. And so the excess savings by households since COVID, some people estimate as equivalent to the GDP of Japan and Germany. So, maybe those estimates are a bit high, but it's still a massive amount of savings that could be unlocked if people get their confidence back. The problem is There are challenges in the Chinese economy. The property market is weak. Consumption has been weak. And so the risk is that there's this deflationary spiral. And so what most economists would argue is that you need more stimulus from the government. Now, the Chinese have been very reluctant to do that because they want to stop the excess speculation in property and build out of debt. And so there is a rationale for it, but there is a risk that if the property market continues to slump, consumption remains weak, that continues to drag the economy down. So I think it's a big topic for this year for the Chinese authorities. But I would say that there's a two-step economy in China at the moment. There are areas that are doing very well, more driven by the industrial side of the economy, be it electric vehicles, renewables energy, AI and robotics, and healthcare like biotech. So there are areas of the economy that are doing well, but obviously property and consumption are a big chunk, and property used to be the biggest chunk. So that's been a big drag. So it's not a simple transition, but we think that they're doing actually a reasonable job, but we'd like to see more stimulus on the consumption side. I think that would help revive some animal spirits and get that spending up, which as a larger, richer country, China needs consumption to drive more of its economy.
And can I ask you a quick comment on India? I mean, one of the issues about investing in Asian funds, obviously it's less of a problem in the small cap, as you've said, because the kind of regional dominance is not so great. But basically, I mean, you have to take a view about China, you have to take a view about India, because they're the two largest components, I think. So the Indian market's been very expensive, as you've said, it's, high growth, quite a dynamic economy now, or very dynamic economy. Obviously, Modi seems to be trying to position himself as everybody's friend in the world at the same time, but not so successfully with Mr. Trump. What are your thoughts about the Indian economy and the opportunities that presents and the prices you have to pay to get into?
So India is the most exciting market from a small mid-cap perspective because it's got a thriving private sector who rely on the equity market. So there is an equity culture as well. I think the Bombay Stock Exchange is one of the oldest stock exchanges globally. So there's that equity culture. There's some fantastic businesses run well. So we really like the story in India from a bottom-up point of view. And from a top-down perspective, the government had been reforming significantly, and there's lots of growth. So it's a good backdrop for us with good growth and good companies. Now, we're underweight India in the portfolio versus the benchmark because purely valuations are high. And I think that the risk to India, people talk about oil imports. I think that's less of a concern these days. I think the risk is more on the politics side and who comes after Modi. I think one of the good things, and I think the economists picked up on this recently as well, is that with the elections where Modi didn't gain a supermajority, that was, I think, quite positive for India because it curbed the more dictatorial, if I can put it that way, instincts of a leader with a lot of power. So he's had to moderate things like his very strong of the party, very strong sort of Hindu nationalist instincts, which would have alienated the Muslim minority, which is a minority, but it's still a massive number of people in an absolute sense. So it could be quite disruptive. And he's also had to cater more to the rural population, which were getting left behind. So in some senses, I think what the economists were saying, which I agree with, is that it's made him have to govern more fairly and more in a more balanced way. So I think that's positive. What comes next is the big question because India has been a story of there's hardly anything to fault the story. The narrative is very good. And as you say, India's friends with everyone. I think the tariffs that Trump implemented on the back of their imports of Russian oil, that was a moment where you thought, okay, they're not going to be able to play that game of being friends with everyone. But, recently you've actually seen some important developments there with the EU trade deal and also a trade deal with the US. So that's helpful for sentiment. But if you see that sentiment change, you could see derating in valuations. But typically India, there's a bit of an India exceptionalism, I would say, within emerging markets where it trades at a premium because you have this longevity of the growth story. It's like a massive frontier market, essentially, in terms of the penetration of goods, just GDP per capita, etc. But at large scale and with actually good governance. I think the government has been doing a good job from an economic point of view in terms of driving things forward. So I don't know if that helps, but yeah, we like India. It is about 21% of the portfolio today, but it has been higher. So we have been letting it drift to an extent and rotating into other areas because of valuations. But we jump back in. It's a case by case at the stock level if you have confidence in the earnings outlook.
Well, we've talked a lot about Asia and what's actually happening out there and the opportunities it presents, but we haven't talked much about the actual trust itself. Your trust trades at a discount. I think it's currently around 9%, something like that, which is narrower than it has been. And the range has been wider than that, I think between 9 and 17. I had a quick look at some numbers. Averaged in the past 13%, which is quite wide compared to other trusts. The trust has been buying back shares, and you've also made some changes to your gearing. Obviously, the discount is in a sense a matter for the board, but how does that impact on what you've been doing? Is there a discount target that you're trying to get to? If so, what is it? And how do you use gearing? How do you think about that in terms of using that to add to the returns?
I think discounts are a perennial frustration for boards, and I think investors will have different views on it. I think there has been a desire to reduce the discount, of course, and I think despite the very strong performance of Asia Focus over the long term and actually over the short term, which hopefully has helped narrow that discount, we sit wide relative to equity trusts and even Asian trusts. And I think that's because of that perception of small caps being higher risk. But what I would say to that as well, which is, I think few people pick up on, is that actually Asia small caps has done better than large caps over the last 5 years, which is not the case in the UK, US, Europe, I think even Japan. So it has been a strong story, and I think the diversification story is strong. So I think performance will drive that lower. But the board have been much more active on buybacks as well. I think it's a good thing to do. I think there isn't a set target in terms of the discount. I think obviously the lower the better. But coming into below 10%, I think has been a good threshold to breach. And the board did a lot in 2021, 22 to try and make the trust more attractive from a discount management point of view in terms of putting in place a conditional tender offer, doubling the absolute dividend of the portfolio. We removed the market cap limit of the trust as well to have more flexibility to invest in places like China. So there's been a few things that the board have done and a stepped up marketing as well. But in terms of the management of the trust, there isn't much that has impacted us. The dividend has been fully covered by income, even though we doubled it. And so we don't specifically target when we look at companies a particular dividend yield. We think about it more as a overall one of the valuation metrics that we use when we consider investing in companies. On the gearing, I think our capital structure has been simplified essentially in the last year, but we have two instruments. One is a fixed 15-year note, which was locked in during COVID, so at quite attractive rates. That's about half of the gearing, and roughly the other half is now variable debt, which we converted. We switched 1-to-1 from a convertible instrument, a calls instrument that we had that matured in May of last year. And so the way we think about gearing is we like to be structurally geared. We think that's one of the attractions of the investment trust vehicle. We don't want to go crazy. So typically you would see the gearing from 5 to 15%. 15% would probably be on the high side. It's been closer to 10 for the longest time, really. And the gearing has added between 1 and 2% annual NAV returns, just purely as a result of the gearing of the last 5 years or so. It's been additive to performance. We very recently nudged it down slightly because we've had good performance, both absolute and relative, but it's quite a minor reduction, and we don't want to be playing around with the gearing. We see it more structurally, sort of structural attraction of the trust.
So finally, then, we'll just return to basics, if you like. What are the risks that you will be unable to maintain the kind of impressive pace you've set over the last 30 years and also over the last 5 and 10 years, let's be fair? You mentioned maybe valuations are a little bit high, one or two places, but how do you sum up the prospects from here, if I can put it that way, without putting words in your mouth?
I'll start with the risks. I think small caps are always prone to big drawdowns when there is a crash. So COVID, small caps were very, very weak, but then they tend to rebound quite fast as well. So there can be periods where it is a bit worrying, the correction that you see. So we're not going to be immune to that. And I think there are risks individually across companies and countries. So the important thing is that we are diversified and that we focus on quality businesses. I think that will stand us in good stead over the long term. And I think if you look at the NAV return of the portfolio, 12 to 13% or so over 30 years, we think that over the long term, that's sustainable because our companies can deliver that level of earnings quite comfortably. That's what we're targeting. Obviously, if we overpay, we won't get the earnings and dividends coming through. We can get a D rating. So we need to make sure also we're not overpaying. So to your point on valuation, there are pockets of the market where valuations are a bit higher. So we're trying to take profit and position the portfolio in areas that also are a bit more contrarian, which are things like Southeast Asia. It was China. So we ramped China up a few years ago. Korea was a cheap market, but it's fast re-rating as well. So we just need to be sensitive to those things, and we're being a little bit more active in rotating the portfolio, given we've seen such huge dispersion in returns across markets. But, I think the Asia story is really unstoppable. If you think about the representation of these countries in terms of population, in terms of GDP, in terms of growth, and the health of these companies in terms of the balance sheet and cash flow that they're delivering. So we think it's definitely worth people allocating to the asset class, whether it's a small amount to diversify or, you have more confidence. And we do think it's a part of the market that's largely ignored and shouldn't be.
So that was Gabriel Sacks, who is the lead manager of Aberdeen Asia Focus, the 540 million market cap investment trust that sits in the Asia smaller companies sector.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.